Today's question is, what is PMI and how can I avoid it? PMI stands for Private Mortgage Insurance. It is an insurance to protect the lender, and a client has to pay it if they don't put down at least 20% on a mortgage loan. Let's be clear, it's not evil. Let me explain how it came to be. In the old days, when you bought a house, when you got a mortgage, you had to put down at least 20%. That was pretty standard. 20%, and if you're putting down 20%, then the lender is only loaning 80% of the investment. So if anything happened and they had to foreclose and take the house back and then sell it, they were pretty sure they were going to get their original investment back. Because keep in mind, when they liquidate a house, they're not trying to maximize the sales price. They're literally selling on the courthouse steps. But if they only have 80% into the house, they're going to get their money back. Well, nowadays, people are borrowing 96.5%, 97%, even 100% of the purchase price of a house. These are high-risk loans. PMI came to be as a way to protect the lender in case of default of a mortgage loan. Like I said, PMI is not evil. In fact, if it wasn't for PMI, a lot of these high loan-to-value loans probably wouldn't exist. You know, the 97% loans wouldn't exist. So if you have to pay it, at least for a short period, don't fret about it. You know, there's only a couple ways to really avoid it. One, pay 20% down, just like the old days. If you put 20% down, you do not have to pay mortgage insurance on any conventional loan or most loans. Another way to avoid it would be if you put less than 10% down, but you do what they call a piggyback loan. So say you borrow 90% you borrow 80% on one loan and then borrow another 10% on another loan, and you know this is set up by your loan officer. That's one way to avoid mortgage insurance. But keep in mind that 10% piggyback loan is going to have a much higher interest rate than your 80% loan. So I don't know how much of a benefit it is. The only other way I know of avoiding PMI is to have the lender pay for it, and you're kind of not really avoiding it. What happens is the lender will pay your mortgage insurance for you, but it'll factor into your interest rate, and it'll raise your interest rate 0.75%, maybe a full percent. It really depends. But with PMI, generally speaking, once you get that loan to value, you've paid off the mortgage to where it's worth only 80, or more accurately 78%, 80% of the value, or 78% of the original purchase price, PMI disappears. You no longer have to pay. You have the lender pay for it, and it's factored into your rate. Well, it's factored into your rate for life. That whole 30 years you have that mortgage, if you keep it that long, you're going to be paying for it. Okay, hope that answered your question. Thanks. Thanks for watching. Please subscribe. And if you have any questions you'd like me to address in a future video, please leave it in the comments below. If you're in Florida and interested in a mortgage, check out the description for my links. Thanks again.